Hello, ladies and gentlemen. Welcome to Grant's Interest Rate Observer Radio. With me today is Evan Lorenz, known in these parts as the Great Evan Lorenz for his analytical capacities and talents and production. And also at the controls is Eric Whitehead, who runs the place. Actually, Eric does. And I'm Jim Grant, and we are here to tell you about American finance, indeed world finance, the whole shooting match. But not before a word from our sponsor, who is me, actually. Now, no time is a bad time to subscribe to Grants, but now just might be the best time. Now, when markets are making highs and volatility is plumbing lows, and the SEC, in its wisdom, has waved through the first quadruple levered ETF. That's right, Evan, quadruple levered for 4 times the tracking error and 4 times the leverage and 4 times the disappointment. Grant says, we are the yes but people. We are skeptics, doubters, first guessers, whether it's macroeconomic theory or a common stock or a subordinated debenture. Grants puts it to the analytical test. We publish every 2 weeks, 24 times a year. So visit our website and read for yourself and see for yourself. And as we encourage every reader, think for yourself. Subscribe to Grants. There's no time like the present. Evan, what do you make? What do you make of this new ETF? Is this not a sign of the times?
It certainly is. We are, according to a Bank of America Merrill Lynch report, over the last 90 years, there's only been 3% of the time where the market has actually had lower volatility than today. So that's like roughly 2 years out of 90 years. So we're at this historically low period in volatility where people are putting up these instruments that just magnify any kind of changes and magnify any kind of risk or blowups or any kind of hiccups or problems along the way. I mean, people forget just how little it takes to kind of shake the apple cart. In August of 2015, a few U.S. Stocks were halted in trading, and dozens and dozens of ETFs fell by 20% or more. Almost no stocks that day fell by 20% or more. But these are instruments where when liquidity vanishes, their price swings can be a magnitude of that. And the ETFs that fell like 20% weren't the 2 times levered or the 3 times levered. They were just normal ETFs.
Yeah, the dividend special ETF was one that had a rough day.
Yeah, that was a supposedly low volatility ETF, one you buy for safety, and it fell 20%.
Well, I read actually in Almost Daily Grants, that fabulous daily emission produced by a fellow named Phil Grant, who is, it's fine, my son. A little nepotism is fine. It's too much nepotism that gets you in trouble. But Phil writes daily, or as he insists, almost daily. I think he takes Saturday off. And yesterday he reminded us that Ben S. Bernanke, PhD, himself was a guest on Squawk Box on CNBC, I think on Monday. And this was some appearance. And in it, the former Federal Reserve Board chairman took a kind of a end zone dance type bow. He was saying that not so long ago, people on shows like this, which if I were the head of Squawk Box, I might feel that was a little patronizing, but shows like this were saying, and now I quote, that we were going to be having hyperinflation and huge stock market bubbles and dollar collapse and all kinds of terrible things were going to be coming down the pipe. But in fact, it's gone pretty smoothly and on and on. So,
well, 1 out of 3 ain't bad. We got the stock market bubble.
Yeah. Well, if I certainly would not presume to advise the former Fed chairman on his public affect, but it seems to me slightly premature to be taking a bow about the full trade, that is full monetary trade, that is putting it on and taking it off. Putting it on was relatively easy, although I dare say it was no easy thing for him or for the Federal Reserve Board. Give him that credit. Putting it on, however difficult it might have been, however personally harrowing the experience might have been for the chairman, I think it will rather pale compared to a moment of truth still perhaps to come, in which the Fed is seemingly committed to remove this immense accommodation in the middle of some unscripted event. Now, there was a great Frenchman of yesteryear, lived in the 19th century, called Friedrich Bastiat. And Friedrich Bastiat talked about public policy, and he said that there are 2 things you must consider, quote, that which is seen and that which is unseen. And Chairman Bernanke, in enumerating the successes of his very own program, the program that he extolled himself in his somewhat grandiloquently titled memoir, The Courage to Act, The former chairman extolled this program then, and he extolled it on television. And the points he made in support of the claim that it has been a great success, the points he made had to do with those things that are seen. Let's say the stock market is not in a bubble. We can talk about that. I guess we will. But certainly there's been no hyperinflation. Certainly there has been some measure, in fact, a great measure over many, many, many years of economic recovery. There's been a measure of recovery in the labor market. All true. Those are things that are seen. But there are things that are unseen. And one of these just might be the subversive effects of ultra low interest rates and the expectation of more of the same. You mentioned this volatility business. You know, volatility has become a thing on Wall Street, Evan. It's not just a theoretical concept in a finance textbook. It is a thing itself. There is a great VIX industry. And what is so remarkable about this measure of motion in finance is that whether the measure is of realized volatility, as they call it, or anticipated volatility as it's traded, these measures are plumbing 10-year lows. And I don't know, I don't think that is an especially good or wholesome thing.
Yeah, I believe on Monday, the VIX touched down to 9.9 on an intraday low, which is the lowest since February of 2007, if memory serves. And February of 2007 wasn't the greatest prospective time in the markets.
Yeah. Well, and irony of ironies, these measures of volatility are touching their lows during the administration of the man at Grants, that Grants has called the avatar of tail risk. The 45th president himself, Donald J. Trump, is presiding over the crushing of the VIX. Go figure. So, Evan, we don't like to give away too much of the contents of Grant's Interest Rate Observer because it's too precious to be broadcast on the air to just anybody. You must be a paid-up subscriber to partake fully of this magnificent brand. This is the proprietor talking. But I am prepared to ask you about your work on the Swiss National Bank, the publicly traded central bank in the formerly great financial center of the middle of Alpine Europe, Switzerland. I would say it's formerly because it has been in a period of most remarkable financial shenanigans, and perhaps you can tell us about some of them.
The Swiss National Bank has one basic policy mandate, and that is price stability in Switzerland. And it tries to achieve it in the most curious way, which is basically buying foreign-denominated assets in order to hold down the value of the Swiss franc. And it does this by printing Swiss francs. The amazing thing is if you look at its balance sheet growth since 2007, which was the start of the U.S. Great Recession, their balance sheet was approximately 20% of Swiss GDP. And if you look at the end of the first quarter, it's now 117% of Swiss GDP. The curious thing here is if you look at its footings, it actually looks like it's pretty well financed. It's levered less than 10 times to 1 versus the Federal Reserve, which as the last reading was levered 110 times to 1.
111.6 as of the average for 2016.
As of the average of 2016. But a lot of the Swiss bank's strength is that it marks its assets to market. It's been buying stocks, it's been buying bonds, it holds a fairly large pool of gold. And it takes those marks and it basically writes them up to capital. So its capital's basically been a reflection of this huge asset market surge. The Fed, to its credit or to its detriment, does not mark its assets to market. It holds securities at face value, and in a separate line item, it'll mark down the premium or discount that it purchased the bonds at. But basically, it holds everything steady. It does not show any volatility.
Well, there are in this Swiss National Bank's finances, there is the outline, the lineament of old-time classical central banking. In the day, these central banks, including the Bank of England, were stockholder-owned institutions. In the day, their financial presentation was meant to reflect either the strength of the currency over which they were the steward, or the anticipated strength if the bank continued to mind its P's and Q's. The Fed, in its financial, it's a shambles financially. The Fed, I think, what we have said in Grants, is expressing through its own utterly discombobulated financial presentation, it's kind of expressing the chaos of present-day monetary arrangements, in my opinion. Floating exchange rates, manipulated exchange rates, manipulated interest rates, and here I am sermonizing, Evan, when we were supposed to be informing. Let us leave the the theme of lamentation, to which I am all too prone, and let us talk about a specific example of how present-day credit conditions perhaps flatter the underlying condition of the companies that do the borrowing. And I have in mind a company called Sprint, telecommunications giant, the fourth largest, is it, in America?
I believe so.
Yeah, and this featured in Grants a while ago. I guess we can talk about it because, maybe word has gotten out. We're bearish on it. But tell us a little bit, Evan, about what happened. We speak late Wednesday, if my calendar is correct. And today came news of a loss of subscribers to Sprint. The stock price reacted, and the bond price reacted, but in a different way.
Yeah, so Sprint's in a price war with T-Mobile, AT&T, and Verizon. It's leading with unlimited data plans that are very, very competitive. If you're out to get a new cell phone, you might want to look at the Sprint plans. Despite nearly giving away these contracts, they lost 118,000 postpaid subscribers in the quarter ending March 31st. As I last checked the Bloomberg before walking in to do the podcast, the stock was down 15.3%, which is pretty substantial. But if you look at the Sprint 7 7/8 of 2023, they actually rallied to 113 today from 112.6 yesterday. These bonds are priced to yield 5.4%. This is a company that barely was free cash flow positive this quarter, is likely going to have to dramatically increase its capital spending in the next couple quarters as it builds out its 5G network. AT&T came out this morning and said they're going to have to spend over $5 billion just to get up to this. And it's losing subscribers. The stock holders are panicking, and the bond holders are, looking at
placid, serene,
happy, sedated.
Well, we wrote about, sedated perhaps. We wrote about Sprint in the middle of, it was the last issue of 2016, December. And at the time, I am chagrined to acknowledge the Sprint, the issue you just mentioned, the 7 3/8 2025, changed hands at 103.5 or thereabouts, the price to yield 7%, and now they are at 540. So everything that we said about the credit quality of the company has been, I think, vindicated. Everything except the direction of the securities that we were targeting. So that's show business. It certainly is show business in a time of credit limitation and of midget interest rates. But this too is beginning to sound like a lamentation. What can we talk about, Evan? It's a little bit slightly more, less self-pitying and more upbeat.
The job market. I mean, economic readings right now are a little bit, on both sides.
They're marbled, aren't they?
They are. Like GDP growth fell from 2.1% in the fourth quarter to 0.7% in the first quarter. But if you look at withholding taxes, those are the taxes that employers send to Uncle Sam as opposed to you, me, or other people who are employed. They're up 8% over the last, I think it's 8 or 10 weeks year over year. The Federal Reserve in its statement today on Wednesday said, information received since the FOMC met in March indicates that the labor market has continued to strengthen even as growth in the economic activity has slowed. And that's a pretty good summary of it. While there seem to be more people employed and they're earning more money from the withholding tax data, consumer spending's been pretty weak and would indicate something else. This might actually get into the point of what is underlying demand and how much has easy finance kind of stimulated activity.
Yes. Well, the auto market is, to me, Exhibit A in this respect. There was a call, was it the other day, Sonic Automotive was asked to estimate the level of demand in the car and truck market in the absence of preternaturally low interest rates and credit stimulus. And Evan, would you care to read from the non-obscene portion of the transcript that recorded?
Sure. The Jeff Dyke, who's the EVP of operations of Sonic Automotive, which is a very large U.S. auto dealer, said, and I'm going to change one word here, that's a heck of a question. I mean, it's going to be a heck of a lot lower than it is today. I mean, there's no question that the incentives are, we've got a lot of pull ahead coming. So in its natural state, it's probably a 15 million SAR, 14 million SAR, who knows? And just for data, the auto SAR clocked in at 16.8 million in April. So that would be a substantial downturn.
Well, in closing, I would like to issue another complaint to the world, to whoever is administering the credit markets of the world. It can't be just one central bank. There must be a conclave of these guys who are doing the great big thinking. But there there's a security just issued in the Eurobond markets denominated in euros, and the issuer is Netflix, which is the aspirational Hollywood movie-making mogul. Netflix is a chomper of free cash flow. It consumes it by the job lot because it turns out making of movies is a really, really expensive line of work. So it must come to the bond market. It must return to the bond market as it did in Europe just the other day. And here are the terms that it met. It issued, I think, $1.3 billion of euro-denominated 10-year debt. And there were orders for something like, was it $5 billion? There was a massively oversubscribed. It was massively oversubscribed. This single B issue was. It was light in the Department of Covenants, fine print that protects the bondholders, light in that department. Light in yield, to be sure. The coupon was 3 5/8. This is for a single B rated issuer that is burning cash. Now, the stock has been making new highs, and I don't know enough about this to comment on the stock. Perhaps the stock is a good speculation. I don't know. What I think I do observe is that for the bondholders, the risks are totally asymmetrical. If things work out, if this movie-making business proves a winner, they will earn this coupon, and they will earn the return of their principal on time. That is their value proposition. If, however, the market wakes up one morning, the stock's down 40% because what? Because Amazon or Google or one of these other monsters of the midway has bested Netflix in the business of making new content as it's called. In that case, the bonds would stand to partake a little bit, perhaps substantially, of the failure of the business model. So the upside is your coupon plus principal. Principal, by the way, which the European Central Bank is doing its best to devalue. The target is 2% a year. So you get back, at the end of 10 years, you get back 80% of what you paid in purchasing power. You get the coupon along the way. Thanks, 3 5/8. And you get to imagine the business risk you're taking between the hours of, say, 2 in the morning and 5. That's when you knew you're worrying. So this has been, I don't know, I shouldn't be ill-tempered because we published another great issue of Grants last night. Thank you. Thank you, Evan. And here I am spending so much of this broadcast talking about what's not going right. Well, actually, I don't apologize because I think many things are not going right. I think the financial markets are being anesthetized through the well-intended but still baleful interventions of the central banks. And I think that we are in for a lot of trouble in the months and fiscal quarters ahead. That's what I think. But Evan, thank you for being here. Eric Whitehead, thank you for shepherding us through this technological adventure. And ladies and gentlemen, thank you for listening. Till next time, this is Grant's Interest Rate Observer of the Air.